Hello and welcome to this session in which we will discuss the purpose of regulation and highlight few main regulation that deals with the financial market. If you remember from Farhat Lectures, the company that we created that needed money from the financial market, from Wall Street. Investors, lenders, private equity, other people who are interested in this company, what did they do? They invested in this company. Now, these people, these investors, Wall Street, people who invest in companies, they want to make sure that they are protected. Protected from what? Protected from fraud, protected from unethical behavior. So here's what the government comes in and will try to regulate this market, this financial market. What does regulation mean? It means trying to protect this system, to make sure it's transparent, to make sure it's open in a sense that people who are investing, they know exactly what they are invested in. Now, whether the investment is good or bad, that's up to the investors to decide. But at least the company, Farhat Lectures, is disclosing all the necessary information for them to make the decisions. Now, these regulations, usually they come about after an event, a major historical event. So I'm going to put them into that historical context, but I want you to think about the big picture. Why? So regulations are designed to reduce the conflict of interest between managers, people who work at the company, and the shareholders. The shareholders, they want to be protected. And specifically here, when we deal with shareholders, we're looking at publicly traded companies. Why publicly traded companies? Because publicly traded companies are open to the public. Private companies, if you want to invest in a private company, the government will not protect you because that's your choice. You have to make that decision for yourself. But for public companies, you need that transparency. So the main goal is to require public companies. Public companies are the companies that sell their stock to the public. You are required to disclose all relevant financial and operational information to current and potential investors. Therefore, if Farhat Lectures wants money, you remember I raised $5 million. This is just a made-up number. I wish I can do that. Actually, not I wish. I don't need it. But if I want to raise money, I will have to disclose financial and operational information to the investors. So this allows the investor to have equal access to information. And we're going to revisit this equal access to information later on, which create a level playing field. So what's the reason for this? Is everybody knows everything about the company before they invest. They all know the same information. Now, one party is being favored over other party. You just disclose to the public. Again, why it matters? To protect investors. And why is that important? Let's talk about why that's important. Because if you protect investors, investors are more likely to invest. And if investors are more likely to invest, we create new companies, we create jobs, and the economy will grow, and we become all better off. This is how companies grow, like Facebook, Microsoft, Apple. You needed people to invest. This increases market confidence. If you invest, you know your money is protected, and ensure fairness in securities market by preventing manipulation and misuse of confidential information. We're all on the same page. We're giving the information for everyone at the same time. So what we will do in this session is go over major regulations that deals with the financial market. We have a lot of them. Sometimes they are on a state level. We're going to look at federal regulations, and we're going to look at the major ones. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Our corporate finance course is best for online students and students who are taking corporate finance courses. We cover financial statements, discounted cash flow, stock valuation, bond valuation, NPV and capital investment decisions, cost of capital, risk and return, as well as other topics. Our course include lectures as well as multiple choice questions. Go ahead and start your free trial today. No obligation. We are here to help. Your success starts here.
We will start with the Securities Act of 1933 or 1933 Act. Now, there is a reason why the year is listed in the Act. They always list the year because, again, we have to look at it from a historical perspective. The Securities Act of 1933 came after the Depression. Well, what happened is during the Depression, people lost faith in the market because at that point in the 20s, the markets were not regulated. It means the market were private enterprise. The government had no saying. As a result, people were buying companies that did not report the correct figures. No one was watching the market. People lost a lot of money. Sometimes people invested in money in companies that don't even exist. So what happened? The government says we are going to now, going forward, to regain confidence in this financial market, we're going to intervene and ask companies to do certain things. So the first thing you need to know about the Securities Act of 1933, it applies to new securities offering. It means what? Think of IPOs, initial public offering. It means when the company sells their stock to the public for the first time. So before you can, as a company, so here we go. So you have a company, and that company is private, like let's assume Facebook. I always called Facebook, it's Meta, but Facebook, company named Facebook, it was private for a long time. Then they wanted to go public. Before you go public, you have to comply with the Securities Act of 1933. So when you want to sell your stock, when you want to sell stocks of Facebook or Meta or Google or any company to the public, you have to comply with this. The main requirement, you must file a registration statement with the Securities and Exchange Commission. Securities and Exchange Commission is the government entity that handles, that enforce the Securities Act of 1933 before you sell those securities to the public. The purpose, straightforward, to ensure potential investors have enough information to make informed decision. Again, you want to force the companies, literally force them into disclosing the necessary information. So the information that typically involved in a registration statement filed with the SEC for new offering would involve the following. I'm going to give you a list of things. This is not a complete list, just to give you an idea what's required. The description of the securities offered. What type of stocks are you selling? Is it common? Is it preferred? The description of it. Why do you need the money? Usually it's to grow. The risk factor associated with the investment. You just tell them, this is our business and here are some risk factors you have to take into account. Company's business overview of an operations. Here you'd have to submit your financial statement, specifically audited financial statement, and basically a financial report. You would have to submit something called MD&A, Management Discussion and Analysis, discussing the financial conditions and the results of the operation. What do you think about the company? Financial statement. In most cases, you'll have to give those. Executive compensation, information about the director and the officers, who's in charge of this company, any legal proceedings, if any, against this company, ownership structure, principal shareholders, who are the main shareholders, so on and so forth. So this is not a list. So what do you need to take from this? Few things. 1933 deals with new offering, new securities offering for the first time. And I'm going to tell you right now, it's the most stringent. Why? Because when company first go public, you have to be the most careful with it. Therefore, new securities have the most information. We have to disclose the most information. The next thing is we're going to be looking at the 1934 Act, but this act is called the Exchange Act. So let's take a look at the 1934 Exchange Act. Let's look at the name. It's called Exchange Act. Exchange what? You are exchanging stocks among shareholders. Now what happened is the company is public. After the company becomes public, you as an investor, you can sell your stock to someone else, or you can buy the stock from someone else. So here the company is out of the picture. The company is out of the picture. This is called the secondary market. Now people or companies or whoever, traders, they are exchanging those stocks among themselves. So this focus on the ongoing trading of securities in the secondary market. Secondary in contrast to the primary market when they were initially sold. Again, the SEC is involved in this, oversees the corporate reporting and enforces trading. Now once you become public, well, you pass the 1933 Act, the government don't go home and they say, okay, see you later. Our job is done. Absolutely not. They require you to do what? To file certain reports periodically. And we're going to look at three main reports that you have to file. The first one is 10K. You have to file this report annually. This would include your audited financial statements, the notes, information about the company, so on and so forth. Then you have to file quarterly financial statements. It's called Form 10Q. Those are not audited, they are reviewed. Don't worry about this. It's for a short period of time, it's quarterly. Then you have to file something called 8K. If something happened in between each quarter, like the CEO left, you fired the CEO, you are going to acquire another company, you're going to be acquired. Basically, 8K is major news about the company. Are these the only report? You guessed it, absolutely not. But those are the main requirement for the Securities Act of 1934. Again, it's part of that Depression era to regain confidence in the market. Now, the 1934 is less stringent for two reasons. One, it's people amongst each other. Two, the stocks is already traded, so you know what the fair market value, so it's your fault versus an IPO. An IPO, the government is more stringent. Within the 1934 Act, we're going to be looking at something called insider trading. This is an illegal thing, which is what? Illegally buying and selling securities based on non-public material information. You remember in the first slide, I said we are trying to make the playing field equal for everyone. How about if someone inside the company knows some information? And that information is important. So because you know it, you know what's going to happen to the stock. It might go up, it might go down once this information is public. Can you act upon it? And the answer is absolutely not. You cannot do so. So if you do so, if you trade stocks, if you buy or sell stocks on information that's non-public, you violated and you could go to jail. Now, it's very hard for the government. It's getting easier because now we have emails, but it's hard for the government to prove insider trade, to prove that there was insider trading. So who's restricted? Who knows information? Company insiders, directors, officers. Anyone that knows information about the company that's not known to the public yet. That information could be about mergers, dividend, financial performance, any event that the company did not disclose. People inside the company cannot disclose it, tell their friends, their spouses to act upon it. It's illegal to do so. So if you learn that a company is about to acquire and buy its stock, if you learn that a company is about to be acquired and buy its stocks before the public find out, that would be illegal insider trading. So you work for company A and you know, because you're part of the management executive team, that you know company B wants to buy you. So what you do, because you know company B is going to buy you, you know the price is going to go up. So what you do is you buy stocks before that news becomes public. Once the news becomes public, you sell the stock and you make a profit. You can't do that. Let me give you a more realistic example, which is it's not really an insider trading. Martha Stewart and the I'm Clone system. Martha Stewart was a well-known businesswoman and TV personality. She sold 4,000 shares of I Am Clone System, a biopharmaceutical company, just before the public learned that the FDA, the Federal and Drug Administration in the US, has rejected their new cancer drug, Erbitux. So she sold 4,000 shares of stock. Now, how did how did the government know that that happened? Well, she sold them, and people were suspicious, so they started an investigation. But what happened is this: Stewart's broker, where she has her shares, his name is Peter Bekanovich, had tipped her that Samuel Waxall, the CEO, and his family members were selling their shares, indicating something negative was about to happen. Now, the government investigated Martha Stewart, and they could not prove that she sold her shares based on insider trading. Hold on a second. So why are you giving me the case? Well, to tell you, it's quite difficult to prove those cases. It doesn't mean they don't exist. There are cases. I just don't want to get into insider trading. Just go Google insider trading, give me some examples, and you will find them. The point is, she went to jail because she lied. She lied when she talked to the federal government. So if you lie to the FBI, you go to jail. So Stewart acted on non-public material information and sold her shares to avoid a loss. She ended up in jail not because she sold her shares. She was convicted because she lied. So the point is, it's difficult because You could say I sold those shares because I needed the money. How can the government prove otherwise unless you have a chain of emails, for example, chain of emails, or you have a record that someone inside the company, which it happens with other people, telling you, in an email, a record email, look, you got to buy now, there's some information coming out. It's written down, then the government can crack down on you. But this is just the kind of Let's take a look at this multiple choice question from Farhat Lectures. In 2002, the US Congress passed the Sarbanes-Oxley Act in response to what? Is it fraudulent financial reporting, deregulation of stock market, continuous increase in inflation rate, increase in US federal interest rate? Well, Sarbanes-Oxley is a new regulation to oversee the financial market. So not to deregulate stock market, if anything, to regulate more of the companies that are listed. So definitely not deregulation. Deregulation is the opposite. It has nothing to do with the inflation rate, that's economy. Increase the US federal interest rate, that has to do with the Federal Reserve Bank. I hope you know it's in response to fraudulent financial reporting by corporation. Corporation, before 2002, they committed many violations, accounting violation. Sarbanes-Oxley came in to address these violations and give confidence to investors. So this way, Wall Street keeps on running. People don't lose faith, don't sell their stock. What should you do now? You should go to Farhat Lectures, look at additional resources, lectures, as well as additional resources to help you understand these concepts better. Whether you are a finance, accounting, CFA, CMA, CPA, invest in yourself. That's the best investment you can make. Good luck and stay safe.